Learn and master the basics of finance, essential money skills for non-finance professionals. Greetings. Want to master finance without a finance degree? This podcast breaks down financial concepts in simple terms for non-finance professionals. Learn how to manage money, invest wisely, and secure your financial future. We simplify the world of finance for non-finance professionals. Whether you're an entrepreneur, freelancer, or someone just trying to make smarter financial decisions, this podcast will give you the knowledge you need to take control of your money. The $5 coffee that cost $10,000. John, a young marketing executive in New York, loved his daily $5 latte. It seemed harmless, but over 10 years, that small habit cost him nearly $18,000 money that could have turned into $50,000 plus if invested. This is the power of opportunity cost. Small daily expenses add up, and redirecting them toward investments can transform your financial future. The entrepreneur who went broke despite making millions. Lisa built a successful online business and was making millions in revenue. But she didn't track expenses, reinvest wisely, or save for taxes. When a slow season hit, she ran out of cash and lost everything. It's a classic case of not understanding cash flow management. Even with high earnings, failing to budget and plan can lead to financial disaster. The engineer who retired at 40 with smart investing. Mike, a software engineer, never earned a six-figure salary but retired at 40. How? He followed a simple strategy, investing in index funds, living below his means, and leveraging compound interest. He let his money work for him instead of working for money forever. This proves that financial independence isn't about how much you earn, it's about how you manage and invest it. The couple who ignored credit scores and paid the price. Emma and Jake were excited to buy their dream home. But when they applied for a mortgage, they got hit with a 7% interest rate instead of the 5% others were getting. Why? Their low credit scores. That 2% difference meant paying $100,000 plus more over the loan's lifetime. A strong credit score isn't just a number, it's the key to lower interest rates and major financial savings. The emergency that wiped out years of savings. David had a great job and was saving for a house. But when his car broke down and medical bills hit, he had no emergency fund. He had to max out his credit cards, leading to high interest debt that took years to pay off. This is why having an emergency fund, 3 to 6 months of expenses, is crucial. Life is unpredictable, and financial security starts with being prepared. Let's start with a simple question. Have you ever looked at financial statements and felt like you're reading another language? You're not alone. Finance can seem intimidating, but understanding the basics is crucial for making informed decisions, whether it's for your business, investments, or personal savings. Why finance matters for everyone. Think of finance as the foundation of success, whether you're managing your paycheck, running a side hustle, or scaling a business. Without financial literacy, you risk overspending, undersaving, and missing opportunities to grow wealth. Today, we'll break down core financial concepts in a way that's easy to grasp and immediately useful. The basics of finance, key concepts you must know. Understanding cash flow, your income minus expenses equals cash flow. The goal? Keep it positive and invest the surplus. Why it's the foundation of financial success. Your income minus expenses equals cash flow. Sounds simple, right? Yet, many people struggle to keep it positive. Without proper cash flow management, even high earners can find themselves living paycheck to paycheck. The goal? Keep it positive, avoid unnecessary debt, and invest the surplus to grow wealth. The six-figure earner who was always broke. James, a marketing executive, earned $150,000 a year. But every month, he barely had anything left. Why? His expenses, luxury car payments, dining out daily, and impulsive shopping kept his cash flow negative. When an unexpected medical bill hit, he had zero savings and had to take a high-interest loan. This proves that high income doesn't mean financial security. Positive cash flow does. The freelancer who cracked the cash flow code. Samantha, a freelance graphic designer, had inconsistent income. Some months, she made $10,000, and others, barely $3,000. Early in her career, she struggled with cash flow, spending big in good months and panicking in bad ones. Then she created a financial buffer, saving 20% of every paycheck and cutting unnecessary costs. Within a year, she had 6 months' worth of expenses saved, allowing her to survive slow periods stress-free. The bakery owner who almost lost it all. Carlos ran a successful bakery, but he didn't track expenses carefully. Business was booming, but his bank account was always empty. The problem? He was spending too much on premium ingredients and unnecessary upgrades without adjusting his pricing. When he finally reviewed his cash flow, he cut wasteful costs, optimized inventory, and raised prices slightly. Within 6 months, his business had a healthy surplus, proving that revenue means nothing if your cash flow is negative. The retiree who outsmarted inflation. Linda, a retired teacher, thought her pension would cover everything. But she didn't account for rising costs and inflation. After a few years, she found herself spending more than she had coming in. To fix her cash flow, she downsized to a smaller home, reduced discretionary spending, and started a side gig tutoring online. These small changes turned her negative cash flow positive, securing her retirement. The young professional who built wealth with one habit. Eric, fresh out of college, earned $50,000 a year. Instead of spending his entire paycheck, he followed the 50/30/20 rule: 50% on needs, 30% on wants, and 20% on savings/investments. After just 5 years, his smart cash flow management helped him save $50,000 plus and start investing early. This simple strategy put him years ahead of his peers who were still living paycheck to paycheck. Key takeaway: positive cash flow equals financial freedom. No matter your income, tracking spending, cutting unnecessary costs, and investing the surplus will set you up for long-term success. The power of budgeting. Budgeting isn't about restriction, it's about financial freedom. A well-structured budget helps allocate money where it matters most. How a simple plan creates financial freedom. Many people hear the word budget and think of sacrifice and restriction. But in reality, budgeting is about control, freedom, and peace of mind. A well-structured budget doesn't limit your life, it empowers you to spend on what truly matters while securing your future. The couple who paid off $50,000 of debt in 2 years. Sarah and Jake had $50,000 in credit card and student loan debt. For years, they made minimum payments, but the balances barely budged. Then, they created a zero-based budget, allocating every dollar to essentials, savings, and debt payments. By cutting back on eating out and unnecessary subscriptions, they freed up an extra $1,500/month. In just 2 years, they became debt-free, proving that budgeting isn't about cutting fun, it's about getting ahead financially. The millionaire who still budgets every dollar. Mark, a self-made millionaire, still creates a budget every month. Why? Because he knows that wealth isn't about how much you earn, it's about how much you keep and grow. By tracking his spending, he avoids lifestyle inflation and ensures every dollar is working for him. His philosophy: if you don't tell your money where to go, it disappears. The college student who traveled the world on a tight budget. Emma, a college student, dreamed of backpacking through Europe but had limited income. Instead of assuming travel was out of reach, she created a strict savings budget. She cut out impulse spending, took on a few freelance gigs, and set aside $200/month for a year. In 12 months, she had $2,400 saved, enough for a month-long trip. Her story proves that budgeting isn't about saying no to experiences, it's about making them possible. The retiree who never worried about money. David, a retired teacher, never made a high salary, but he never stressed about money. His secret? He started budgeting early, always saving at least 15% of his income, and avoiding unnecessary debt. By the time he retired, he had enough savings and investments to live comfortably without financial worries. His story highlights that a good budget isn't about surviving, it's about thriving in the long run. The small business owner who avoided bankruptcy. Lisa, a small business owner, was on the verge of bankruptcy because her expenses were higher than her revenue. After sitting down and analyzing her budget, she cut non-essential costs, negotiated better supplier deals, and restructured her pricing. Within a year, her cash flow was positive again. Her lesson? A budget isn't just a personal finance tool, it can save businesses too. Key takeaway: budgeting isn't about limiting yourself, it's about prioritizing what truly matters. Whether your goal is paying off debt, building wealth, or achieving financial independence, a budget is your roadmap to success. Debt management strategies: not all debt is bad. Learn the difference between high-interest consumer debt and strategic debt that can build wealth. Smart debt vs. bad debt. Debt often carries a negative reputation, but the truth is, not all debt is bad. The key is understanding the difference between high-interest consumer debt, which drains your finances, and strategic debt, which can help build wealth. The shopaholic trapped by high-interest credit cards. Megan loved designer handbags and the latest tech gadgets. She figured, I'll pay it off later. But later never came. After a few years of using multiple credit cards to fund her lifestyle, she had $30,000 in debt at 24% interest. Her minimum payments barely covered the interest, and her balance never seemed to shrink. Finally, she took action. She consolidated her debt into a lower interest personal loan, used the debt snowball method, and cut unnecessary spending. In 3 years, she was debt-free. Lesson: credit card debt is the worst kind of debt. If mismanaged, high interest can keep you trapped for years. The homeowner who used debt to build wealth. John bought a modest home in his late 20s using a 30-year fixed mortgage at a low interest rate. While some of his friends avoided mortgages, choosing to rent instead, John saw his home as an investment. Over time, the property appreciated in value, and he built equity. Years later, he took a home equity loan at a low rate to start a small business. That business became profitable, and he used the profits to pay off the loan early and grow his wealth. Lesson: a well-planned mortgage can be a powerful financial tool, unlike high-interest debt that drains your resources. The student loan borrower who turned debt into opportunity. Sarah graduated with $80,000 in student loans, feeling overwhelmed. But instead of panicking, she focused on ROI, return on investment. She strategically chose a career in tech, where her starting salary was $90,000/year. She lived frugally, made extra payments toward the principal, and refinanced her loans at a lower rate. Within 7 years, she was debt-free and earning 6 figures. Lesson: if your debt helps you earn more in the long run, it's strategic, but only if you have a solid repayment plan. The small business owner who used debt wisely. Lisa dreamed of opening a bakery but didn't have the cash up front. Instead of using high-interest personal loans or credit cards, she researched small business loans and secured one with a low fixed interest rate. She kept her operating costs low and reinvested profits wisely. Within 3 years, her bakery was profitable, and she paid off her loan early. Lesson: taking on debt for a calculated business investment can lead to financial growth if done responsibly. The car buyer who avoided a costly mistake. Tom needed a car for work and almost took out a 7-year auto loan on a luxury SUV with a high monthly payment. At the last minute, he reconsidered. Instead, he bought a certified pre-owned car, financing it for a shorter term with a low interest rate. He paid it off quickly and avoided being upside down, owing more than the car was worth. Lesson: car loans can be a trap if misused. Buying within your means and choosing low interest financing can keep you financially secure. Key takeaway: not all debt is bad, it's how you manage it that matters. Bad debt, high interest consumer debt, keeps you stuck, while strategic debt, mortgages, student loans, business loans, can build your future. The key is understanding your interest rates, having a clear repayment strategy, and ensuring the debt serves your financial goals. The importance of credit scores: a high credit score unlocks better loan rates, lower interest payments, and more financial opportunities. Your financial reputation matters. Your credit score isn't just a number, it's your financial reputation. A high credit score can unlock lower interest rates, better loan approvals, and even job and rental opportunities. On the other hand, a poor credit score can make life unnecessarily expensive. The first-time homebuyer who got denied. James had been renting for years and finally saved enough for a down payment on a house. Excited, he applied for a mortgage only to be denied because his credit score was 580. Turns out, he had missed a few payments on an old credit card, and his score had dropped. With some effort, he paid off old debts, set up automatic payments, and used a secured credit card to rebuild his score. A year later, with a score of 720, he got approved for a low-interest mortgage and finally bought his dream home. Lesson: a good credit score can be the difference between homeownership and rejection. The traveler who missed out on reward perks. Samantha loved traveling and applied for a premium travel credit card to earn free flights and hotel stays. But her application was rejected because her credit score was too low. Frustrated, she took action. She paid off balances, kept her credit utilization low, and never missed a payment. Within 6 months, her credit score jumped to 750, and she was approved for the card. A year later, she used reward points to book a free international vacation. Lesson: a high credit score can open doors to financial perks and savings. The car buyer who saved thousands. David and his friend Mike both bought cars in the same week. David had a credit score of 800 and got a 3% auto loan. Mike, on the other hand, had a score of 620 and was offered a 12% loan. Over the next 5 years, Mike paid $5,000 more in interest than David just because of his credit score. Lesson: a high credit score saves you money on big purchases. The entrepreneur who struggled to get a business loan. Lisa had a great business idea but needed funding. She applied for a business loan, but banks denied her because her personal credit score was below 600. She hadn't realized that late payments on her personal credit cards affected her ability to get business financing. She spent a year improving her credit, keeping balances low, and paying bills on time. Eventually, her score hit 750, and she secured the business loan with a much lower interest rate. Lesson: even if you're self-employed, your credit score can affect your future opportunities. The job seeker who lost an offer. Mark was excited about a job offer in finance, but during the final hiring stage, the company ran a credit check and his score was below 600 due to past late payments. The company saw this as a red flag for financial responsibility and rescinded the job offer. Determined to turn things around, he set up auto pay for all bills, disputed old errors on his credit report, and practiced responsible credit use. A year later, his score was 770, and he landed an even better job. Lesson: some employers check credit scores, especially in finance and management roles. Key takeaway: your credit score impacts everything from loan approvals and interest rates to job offers and financial perks. A high score saves you money, gives you access to better opportunities, and helps you build long-term wealth. Smart investing for beginners: stocks, bonds, real estate, and index funds. Where should you start? We'll simplify investment strategies to help you grow your money. Grow your money the right way. Investing isn't just for Wall Street pros, it's for everyone who wants to grow their wealth and secure their financial future. But with so many options, stocks, bonds, real estate, and index funds, where should a beginner start? The coffee lover who became a stock market investor. Emma loved her daily coffee run, spending $5 every morning at her favorite coffee shop. One day, a friend joked, "If you'd invested in this coffee chain instead of buying lattes, you'd be rich by now." Curious, she looked into it and saw that the company's stock had tripled in value over the last decade. That day, she made a decision: instead of spending $150 a month on coffee, she would invest it. Over 10 years, her investment grew to over $30,000. Lesson: small daily savings, when invested wisely, can turn into serious wealth. The teen who started investing with just $50. David was 18 when he heard about index funds, simple, low-cost investments that track the stock market. With just $50, he opened his first investment account and set up automatic monthly contributions. He never tried to pick individual stocks; instead, he trusted the power of long-term growth. Fast forward to age 30, and his consistent investing had turned into a six-figure portfolio. Lesson: starting early, even with small amounts, gives your money time to compound and grow. The couple who used real estate to build wealth. Sarah and Mark bought their first home in their late 20s, but instead of upgrading to a bigger house when they moved, they kept their first home as a rental property. Over time, the rent covered the mortgage, and within a decade, they fully owned the house. Now, that property generates passive income every month. With the cash flow, they bought 2 more rental properties, creating financial security for the future. Lesson: real estate can be a powerful wealth-building tool when approached with a long-term mindset. The tech employee who missed out on millions. Mike started working at a small startup in Silicon Valley in the early 2000s. The company offered stock options, but Mike didn't think much of it and sold his shares early. A decade later, the company became a tech giant, and those who held onto their shares became millionaires. Mike later admitted that if he had understood the power of long-term investing, he could have retired early. Lesson: patience and long-term vision are key when investing, especially in high-growth industries. The retiree who regretted not investing sooner. Linda always played it safe with her money, keeping everything in a savings account instead of investing. While she avoided risks, she also missed out on decades of stock market growth. By the time she retired, she realized that inflation had eroded her savings, and she struggled financially in her later years. Meanwhile, her friend Lisa, who invested consistently in index funds, had built a comfortable retirement nest egg. Lesson: saving alone isn't enough. Investing is necessary to outpace inflation and grow wealth over time. Key takeaway: investing isn't about luck, it's about smart decisions, patience, and long-term thinking. Whether you choose stocks, index funds, real estate, or bonds, the most important thing is to start now and let time work in your favor. Finance tips for non-finance professionals. Automate savings and investments. Set up automatic transfers to savings and retirement accounts to build wealth effortlessly. Build wealth effortlessly. One of the biggest secrets to financial success isn't about making more money, it's about making smart money moves automatically. By setting up automatic transfers to your savings and investment accounts, you take the guesswork out of growing wealth. The set it and forget it millionaire. Tom, a 22-year-old fresh out of college, got his first job and set up a 401k retirement account. His employer matched 5% of his salary if he contributed the same amount. Not wanting to miss out on free money, he automated his contributions to 10% of his paycheck. Fast forward 40 years without ever adjusting his investments, his retirement account had grown to over $1.5 million. Lesson: small, automatic contributions grow into massive wealth over time. The entrepreneur who paid herself first. Jessica, a small business owner, struggled with saving money. Every month, she planned to save whatever was left after expenses, but there was never anything left. One day, a mentor advised her to automate her savings first, treating it like a non-negotiable bill. She set up a direct deposit of 15% of her income into a separate savings account. Within 2 years, she had enough for a down payment on her dream home without even thinking about it. Lesson: if you don't see it, you won't spend it. The couple who became accidental investors. Sarah and Jake always thought investing was risky, so they avoided the stock market. But when their financial advisor suggested an automated investing plan, they gave it a shot, just $100 per month into an index fund. Because the transfers were automatic, they forgot about it. 10 years later, they checked their account. It had grown to over $25,000 without them actively managing it. Lesson: automating investments helps you build wealth without stress or effort. The parent who secured his child's future. Mike wanted to save for his newborn daughter's college education, but life expenses kept getting in the way. To stay consistent, he automated $200 per month into a $529 college savings plan. With compound interest and steady contributions, by the time his daughter turned 18, the account had grown to over $80,000, covering most of her tuition. Lesson: starting small and automating early can turn savings into life-changing opportunities. The employee who never missed a paycheck but still saved big. Lisa lived paycheck to paycheck, always struggling to save. Then she learned about round-up savings apps where every purchase she made was rounded up to the nearest dollar, and the extra change was transferred to savings. After a year, she had saved $1,500 without noticing. Encouraged by the results, she set up a direct debit of $50 per paycheck into a high-yield savings account. A year later, she had saved over $4,000 effortlessly. Lesson: even small automated savings add up to big results. Key takeaway: the best way to save and invest is to make it automatic. Whether it's for retirement, an emergency fund, or a future goal, automating your money ensures you stay consistent without thinking about it. Understand taxes. Knowing tax basics can save you thousands each year. Maximize deductions and credits to keep more of your money. Maximize your deductions and keep more money. Taxes can feel like a mystery, but the truth is, understanding the basics can save you thousands every year. By knowing how to maximize deductions and credits, you can keep more of your hard-earned money. The freelancer who saved big on tax deductions. Rachel, a freelance graphic designer, was always stressed about taxes. She dreaded the end of the year when it was time to file, and she often paid more than she should have. One year, a fellow freelancer suggested she look into deductions for business expenses, things like her home office, equipment, and software subscriptions. Rachel was shocked to discover she could deduct thousands of dollars in expenses. After working with a tax professional, she ended up paying $2,000 less than the previous year. Lesson: know your business deductions to save more on taxes. The retiree who learned about tax-deferred growth. David, a retiree, had been pulling money from his traditional IRA for a few years but wasn't aware of the tax implications. When he turned 70, he learned that required minimum distributions, RMDs, from retirement accounts like his IRA could increase his taxable income. By switching part of his withdrawal plan to a Roth IRA, where future growth is tax-free, he avoided higher tax rates on his withdrawals. The move saved him thousands in taxes over the next decade. Lesson: tax deferral strategies can help you reduce future tax liabilities. The homeowner who took advantage of tax credits. John and Laura, first-time homeowners, were overwhelmed with the expenses of buying their new house. But they soon realized that they could take advantage of the first-time homebuyer tax credit, which allowed them to claim up to $8,000. They also learned about the mortgage interest deduction, which allowed them to deduct the interest paid on their mortgage from their taxable income. With the combination of these credits and deductions, they saved nearly $10,000 that year. Lesson: take advantage of available tax credits to reduce your financial burden. The small business owner who learned about Section 179. Emily ran a small bakery and always felt her tax burden was too high. After a consultation with a tax advisor, she learned about Section 179 of the IRS Code, which allows small businesses to deduct the cost of certain property like new ovens or equipment up to a set limit. Emily bought a new commercial oven for $15,000 and was able to deduct the full amount from her taxes that year. This deduction reduced her taxable income by $15,000, saving her several $1,000s in taxes. Lesson: business owners can significantly reduce their tax burden with the right deductions. The family who leveraged child tax credits. Mark and Susan, a married couple with 3 children, were paying a lot in taxes but didn't realize they qualified for the child tax credit. They were missing out on an opportunity to claim up to $2,000 per child, which could directly reduce their tax liability. By learning about the credit, they added an additional $6,000 back into their pocket that year. Lesson: tax credits for dependents can lower your tax bill significantly, especially if you have children. Key takeaway: understanding tax basics from deductions and credits to tax deferral strategies can help you keep more of your money in your pocket. Don't let tax season sneak up on you. Educate yourself and take advantage of the strategies that benefit you most. Emergency Fund Essentials: aim for 3 to 6 months of expenses in an emergency fund to protect against unexpected financial setbacks. How to protect yourself from financial setbacks. Life happens: unexpected medical bills, car repairs, job loss, or even urgent home repairs. An emergency fund is your financial safety net to handle these surprises without falling into debt. The goal: aim for 3 to 6 months of expenses tucked away in a liquid, easily accessible account. The job loss that could have been worse. Samantha had been working as a marketing manager for over a decade when the company unexpectedly laid off several employees. While devastated, Samantha had been proactive about building her emergency fund. She had 6 months' worth of expenses saved up, which gave her the breathing room to take time finding the right job, rather than feeling pressured to accept any offer. This cushion allowed her to maintain her financial stability and even pay for a professional course to sharpen her skills. Lesson: an emergency fund can help you stay calm and make better decisions during job loss. The car breakdown that didn't break the bank. Jacob's car was his lifeline, so when it suddenly broke down on the highway, he feared the worst. After getting it to the mechanic, he learned that the repairs would cost over $2,000 more than he had in his regular checking account. Thankfully, Jacob had been diligent about saving and had set aside 3 months' worth of expenses in an emergency fund. He was able to pay the mechanic right away and continue with his daily life without dipping into his savings or going into debt. Lesson: an emergency fund helps you handle large, unexpected expenses without financial stress. The medical emergency that wasn't so stressful. When Alicia, a single mother of 2, had to undergo an unexpected surgery, she wasn't sure how she would handle the recovery time off work. While insurance would cover the medical costs, the lost income was a major concern. However, Alicia had a solid 3-month emergency fund in place, so she was able to take the necessary time to heal without worrying about bills piling up. This allowed her to focus fully on her recovery without the added stress of financial strain. Lesson: having an emergency fund gives you peace of mind during medical emergencies. The home repair that didn't set them back. Paul and Lisa were enjoying their first year in their new home when they discovered a leak in the roof after a heavy rainstorm. The repair would cost nearly $5,000. They were nervous but grateful that they had set up a 6-month emergency fund. They immediately called a contractor, got the roof fixed, and didn't have to put the repair on a credit card or take out a loan. Lesson: an emergency fund helps protect your home from financial setbacks without resorting to debt. The unexpected family emergency. Robert's father suddenly fell ill and needed emergency surgery. As the primary caregiver, Robert had to take time off work to be by his side. While the situation was already stressful, the added worry of lost wages would have made it even harder. Luckily, Robert had an emergency fund that covered his living expenses for several months, allowing him to focus on his family without the stress of bills. Lesson: an emergency fund ensures you can prioritize what truly matters in unexpected situations. Key takeaway: an emergency fund is not just a nice to have, it's a necessity for protecting your financial future and ensuring you're prepared for life's unpredictable moments. Aim for at least 3 to 6 months of expenses, and rest easy knowing you have the financial cushion to handle whatever comes your way. Retirement planning starts today. The earlier you start, the more you benefit from compound interest. Even small contributions now can mean big returns later. How starting early can change your future. Retirement might seem like a distant dream, but the earlier you start planning for it, the more you benefit from compound interest. Even small contributions today can grow into significant amounts over time, thanks to the magic of compounding. The early bird investor. When Sarah, a 25-year-old software engineer, got her first job out of college, she started contributing just $100 per month to her retirement account. While it seemed like a small amount at the time, Sarah's decision to start early paid off in a big way. By the time she was 40, her account had grown significantly due to compound interest, and she had over $80,000 saved up. Sarah didn't have to contribute large amounts, she just took advantage of time. Lesson: starting early even with small contributions can lead to huge retirement benefits down the line. The power of delayed gratification. David, who started his career in his 30s, always thought he had time to focus on retirement planning. By 40, he had yet to open a retirement account. Once he finally began contributing, he realized that the opportunity for growth wasn't the same as it would have been had he started in his 20s. David eventually increased his contributions, but the missed decade cost him significantly, and by 55, his retirement fund wasn't nearly as large as it could have been had he started earlier. Lesson: delaying retirement planning can cost you in the long run. Start as early as possible. The compound interest advantage. Marie, now 50, has been diligently saving for retirement since she was 22. She began with just $50 per month in her 401k, and over time, increased her contributions as her career grew. By the time Marie reached 50, she had over $500,000 saved up, thanks to the incredible power of compound interest. Her early, small contributions snowballed into a substantial retirement fund. Had she waited until she was 40 to start, she would have had significantly less saved. Lesson: small amounts early in life can lead to huge results due to compound interest. The benefit of consistency. Mark, a high school teacher, wasn't earning a massive salary but still made retirement savings a priority. He put away $200 every month into his IRA, no matter what. Mark didn't see the huge jumps at first, but over time, his consistent contributions led to a substantial nest egg by his mid-50s. At 60, he was comfortably retired, thanks to his 35-plus years of consistent savings. His key to success was sticking to a routine, even when it felt like the amounts were small. Lesson: consistency is key. Small, steady contributions add up over time. The missed opportunity. James, now in his 60s, often reflects on how much he could have saved for retirement had he not waited until his 40s to start thinking about it. In his 20s, he was focused on spending and didn't think about his future. By the time he began contributing to his retirement fund, he was already behind. Though he saved diligently in his 40s and 50s, he never reached the financial security that he would have had if he had started saving earlier. James is now playing catch up, and it's a lot harder to build wealth in your 50s than in your 20s. Lesson: waiting too long to plan for retirement can leave you scrambling in your later years. Key takeaway: starting your retirement planning today is one of the most important financial decisions you can make. Whether it's $50 or $500, every dollar you invest today grows exponentially over time through compound interest. So, don't wait, start small, stay consistent, and watch your future grow. The earlier you start, the more you benefit in the long run. Expert insights and FAQs. We asked finance professionals, what's the biggest mistake non-finance professionals make? The answer: waiting too long to start managing their money. The sooner you take control, the better your financial future will be. Common question: how much should I save each month? The 20% rule and how to get started. Saving for the future can feel overwhelming, but it doesn't have to be complicated. A common guideline is to save 20% of your income each month. However, the key is to start wherever you can and gradually build from there. Emily's journey: starting small and building momentum. Emily, a 26-year-old graphic designer, wasn't able to save 20% of her income when she first started her career. At the time, her rent, student loans, and daily expenses took up most of her budget. But instead of giving up on saving entirely, Emily decided to start small. She set aside $100 a month in the beginning, less than 10% of her income. Over time, she found ways to cut back on unnecessary expenses, like dining out less and shopping smarter. By the time Emily was in her 30s, she was consistently saving 20% of her income and had built a healthy emergency fund and retirement savings. Lesson: start with what you can, and gradually work your way up to that 20%. The key is consistency. Jake's rule of thumb: save what you can, then increase gradually. Jake, a 33-year-old software engineer, had heard the 20% savings rule but found it hard to stick to early on in his career. He had hefty student loans, credit card debt, and was trying to save for a house. Instead of stressing over hitting that perfect 20%, Jake focused on saving 10% of his income. After a few months, he realized he could save a bit more, so he increased his contribution to 15%. By the time he was 40, Jake was comfortably saving 20% of his income each month. Today, his disciplined approach has put him on track for financial independence. Lesson: it's not about hitting 20% right away, start with what's manageable and increase it gradually. Rachel's balanced approach: adjusting for life changes. Rachel, a 29-year-old teacher, was always mindful of saving but had an unpredictable income because of seasonal work. During the school year, she earned a steady paycheck, but in the summer, her hours were fewer. Rather than stressing over sticking to 20% every month, Rachel decided to save a fixed percentage based on her income, roughly 15% when her earnings were lower, and 25% during peak months. By the end of the year, Rachel's total savings reflected her commitment to putting money aside, even if it varied each month. She learned that flexibility is key when you have fluctuating income, but still staying focused on saving as much as possible. Mark's experience: cutting back to save more. Mark, a 45-year-old business owner, realized he wasn't saving enough despite having a decent income. After an eye-opening conversation with a financial advisor, Mark committed to saving 20% of his monthly earnings. To make it happen, he started tracking his spending meticulously and cut back on some of his higher costs, like premium cable subscriptions and frequent vacations. It wasn't easy, but after a few months of sacrifice, Mark had successfully built up a solid savings account. This habit eventually helped him fund his retirement plan and invest in other ventures. Lesson: cutting back on unnecessary expenses can help you reach that 20% savings target. Laura's challenge: starting with 5%, then scaling up. Laura, a 22-year-old marketing assistant, was just starting out in her career with a modest salary. She loved the idea of saving 20%, but it felt out of reach. Instead of getting discouraged, Laura aimed for a more achievable goal, saving 5% of her income. By consistently saving that 5%, she got into the habit of paying herself first. Over the years, she was able to increase her savings rate incrementally as her income grew. By the time Laura was 30, she was comfortably saving 20% of her salary and had a growing retirement fund. Lesson: start with a smaller percentage, and as your income grows, so can your savings. Key takeaway: the 20% savings rule is a great goal to aim for, but don't let it overwhelm you. If it feels out of reach, start with whatever you can manage, even if it's just a small amount each month. The important thing is to get started, and as your financial situation improves, gradually increase your savings rate. Consistency is key. Common question: where do I invest if I have limited knowledge? The case for low-cost index funds. When you're new to investing and feeling overwhelmed by all the options out there, low-cost index funds offer an easy, beginner-friendly solution. Index funds provide broad market exposure, are low maintenance, and generally come with low fees, making them an ideal starting point for those who want to invest without needing deep financial knowledge. Sarah's simple start: letting the market do the work. Sarah, a 28-year-old school teacher, had always been intimidated by investing. She didn't have a background in finance and wasn't sure where to begin. After talking to a friend who worked in finance, Sarah learned about low-cost index funds. She decided to take the plunge and invested in a broad market index fund, which tracked the performance of the S&P 500. Sarah didn't have to research individual stocks or try to time the market. She simply made her investment and let the market do its thing. Over the years, Sarah's investment grew steadily without requiring much effort from her. Lesson: index funds are perfect for beginners: simple, diversified, and low fee. Brian's relief: no need for expertise. Brian, a 35-year-old engineer, was looking to grow his wealth but had no desire to spend hours researching stocks or keeping up with market trends. He didn't have the time or expertise to pick individual stocks, and he wanted something that would help him earn returns without taking too much risk. After doing some research, Brian discovered index funds. He invested in a total stock market index fund that provided him with exposure to thousands of companies, from large-cap stocks to smaller ones. Over time, Brian watched his investment grow steadily. The beauty of the index fund for him was that it didn't require his constant attention. He simply invested and let the market work its magic. Lesson: index funds give you a diversified portfolio with minimal effort, even if you don't have time or expertise. Tina's slow and steady approach: building confidence. Tina, a 24-year-old recent college graduate, wanted to start investing but felt lost when trying to figure out where to put her money. She wasn't sure about buying individual stocks, especially since the market could seem so unpredictable. After consulting with a financial advisor, Tina was introduced to low-cost index funds, which seemed like the perfect fit for her situation. She started by investing a small portion of her savings each month into a bond index fund for stability, gradually adding stock index funds as she became more comfortable. Over time, Tina's confidence grew, and her portfolio slowly started to build up. Lesson: index funds can help you grow your investments steadily, even if you're just starting out and need to build confidence. Mark's busy life: earning without constant monitoring. Mark, a 40-year-old lawyer, was looking to invest for his future, but his busy career left him with little time to monitor investments or learn about stocks. He wanted a hands-off investment strategy that would still allow him to build wealth. Mark decided to put his money in low-cost index funds, choosing funds that tracked the broader market. With his investments on autopilot, Mark didn't have to worry about making active decisions or following the stock market daily. The funds grew steadily, giving him peace of mind that his wealth was building without needing constant attention. Lesson: if you have a busy schedule and lack investing knowledge, index funds are a great way to stay invested without extra stress. Jessica's cautious approach, easing into investing. Jessica, a 30-year-old nurse, was hesitant about investing due to her limited financial knowledge. She didn't want to risk her hard-earned money in volatile stocks, so she turned to low-cost index funds to start slowly and safely. She invested in a diversified index fund that offered exposure to both stocks and bonds, providing a mix of risk and stability. Over time, as Jessica's financial literacy grew, she became more comfortable with the stock market and increased her contributions. By starting with a balanced index fund, Jessica was able to dip her toes into investing without overwhelming herself. Lesson: index funds allow you to ease into investing, even if you're not ready to take on much risk. Key takeaway: for those with limited knowledge about investing, low-cost index funds are an excellent option. They're simple, diversified, and low maintenance, perfect for anyone who wants to invest without having to dive into complex financial concepts. By investing in index funds, you can gradually build your wealth over time with minimal effort. Remember, investing doesn't need to be complicated. Sometimes, the simplest strategies are the most effective. Common question: how do I improve my financial literacy? A journey of knowledge expansion. Improving your financial literacy is an essential step towards taking control of your finances, and it's easier than you might think. Whether you're looking to better understand budgeting, investing, taxes, or debt management, there are plenty of resources available to help you boost your financial knowledge. Ethan's commitment, starting with a podcast. Ethan, a 27-year-old software engineer, realized he needed to step up his financial game when he was struggling to save for his goals. He wasn't confident about understanding the language of finance and was overwhelmed by the amount of conflicting information online. One day, while commuting to work, Ethan decided to give financial podcasts a try. He started listening to a popular personal finance podcast, which covered topics like saving, investing, and managing debt in simple terms. The hosts broke down complex financial concepts into digestible pieces, helping Ethan build his confidence over time. By dedicating just 30 minutes a day to podcasts, he gradually felt more in control of his financial situation. Lesson: podcasts are a great, easy to consume way to improve your financial literacy, even during your busy day. Ava's self-paced approach, reading finance books. Ava, a 32-year-old graphic designer, always felt like she was missing the foundation of good financial habits. She knew the basics of budgeting but felt lost when it came to investing and retirement planning. She decided to take matters into her own hands by reading personal finance books. She started with The Richest Man in Babylon and The Intelligent Investor, books that simplified complicated financial strategies and gave her practical steps to follow. Ava found that reading one chapter a day allowed her to steadily build up her knowledge, and soon she was able to make informed decisions about her investments and savings. Lesson: books are an excellent way to dive deep into financial principles and strategies at your own pace. James' strategy, taking online courses. James, a 40-year-old teacher, felt behind his peers when it came to managing his money. He didn't know where to start, so he decided to sign up for a beginner's finance course offered by a reputable online platform. The course was structured to take him from understanding basic budgeting principles to more complex topics like tax planning and retirement strategies. The course included video lectures, quizzes, and interactive exercises that helped reinforce his learning. By the end of the course, James felt confident enough to start creating a budget, saving for retirement, and investing. Lesson: online courses provide structured, step-by-step learning, which is ideal for those who need a guided approach to financial literacy. Olivia's regular habits, following finance blogs and YouTube channels. Olivia, a 25-year-old marketing professional, had always been interested in finance but didn't know where to begin. She started following several finance blogs and YouTube channels, where experts provided practical tips and explained topics like budgeting, credit scores, and investing strategies. Olivia found that reading articles and watching videos about finance every day helped her stay updated on the latest trends and advice. She took notes and gradually applied what she learned to her own finances. With consistent effort, Olivia was able to understand her credit score, find better ways to save, and even start investing. Lesson: staying updated with blogs and YouTube channels can keep you informed and allow you to quickly learn new concepts in a fun, engaging way. Mike's experience, joining financial communities. Mike, a 29-year-old entrepreneur, was motivated to improve his financial literacy when he decided to start his own business. However, he quickly realized that understanding finances wasn't just about making money, it was about managing and growing it. Mike joined several online financial communities and forums, where he could interact with like-minded individuals and ask questions about various financial topics. These communities provided access to real-world advice from both experts and fellow learners. Mike was able to get advice on everything from how to manage business finances to how to invest wisely. The support of the community helped him feel less isolated in his learning journey. Lesson: engaging with financial communities provides real-world perspectives and support, accelerating your learning process. Key takeaway: improving your financial literacy doesn't require a degree in finance, it's about consistent, intentional learning. Start by incorporating podcasts, books, online courses, YouTube channels, or financial communities into your routine. As you learn more, you'll become more confident in making smarter financial decisions and managing your money effectively. Step-by-step plan to learn and master the basics of finance, essential money skills for non-finance professionals. Whether you're looking to improve your personal finances or enhance your professional financial literacy, mastering the basics is the first crucial step. This guide will help you build a solid foundation of money skills, even if you don't come from a finance background. Step 1. Start with the basics, understanding key financial concepts. Goal: gain familiarity with fundamental financial terms and concepts. What to do: learn the core financial terms, understand terms like income, expenses, assets, liabilities, cash flow, profit, and equity. Break down financial statements, learn how to read simple financial statements, income statement, balance sheet, cash flow statement. Understand the concept of budgeting. Familiarize yourself with budgeting concepts such as income allocation, fixed versus variable expenses, and savings. Step 2. Learn the art of budgeting. Goal: create a solid foundation for managing money. What to do: track your spending, record your daily and monthly expenses to understand where your money is going. Create a budget, use budgeting methods like the 50/30/20 rule, 50% for needs, 30% for wants, 20% for savings or debt. Use budgeting tools, start using apps to simplify the process and track your progress. Recommended resources: YouTube channels for budgeting tips. Budgeting courses on social platforms. Step 3. Understand credit and debt management. Goal: master how credit works and manage debt effectively. What to do: learn how credit works, understand credit scores, credit reports, and how your credit behavior affects your financial health. Know the types of debt, differentiate between good debt, example mortgages or student loans, and bad debt, example high-interest credit card debt. Create a debt repayment plan, prioritize paying off high-interest debt first using strategies like the debt snowball or debt avalanche method. Use free online tools to monitor and understand your credit score. Step 4. Start saving and building an emergency fund. Goal: establish financial security through savings. What to do? Open a savings account, set up an account dedicated to savings, separate from your spending account. Build an emergency fund, aim for 3 to 6 months worth of living expenses in case of unexpected setbacks. Automate your savings, set up automatic transfers to your savings account every month to ensure consistent growth. Step 5, learn about investments, stocks, bonds, and mutual funds. Goal, begin understanding how investments work and how they can help grow wealth. What to do? Start with basic investment knowledge, learn the difference between stocks, bonds, and mutual funds. Understand risk versus reward and how compound interest works. Explore investment accounts, learn about tax-advantaged accounts like IRAs or 401(k)s. Invest for the long term, start small with low-cost index funds or ETFs to diversify your portfolio. Step 6, understand taxes and how they affect your finances. Goal, know the basics of tax laws and how they impact your income and investments. What to do? Learn about tax basics, understand income taxes, tax brackets, and what deductions and credits you qualify for. Maximize tax-advantaged accounts, use accounts like 401(k)s and IRAs to reduce taxable income and grow wealth for retirement. Stay informed about tax changes, keep up to date on tax laws and policies that may affect your finances. Step 7, master credit scores and how to improve them. Goal, develop a strong credit score to unlock financial opportunities. What to do? Understand credit score ranges, know how your credit score affects your loan interest rates, credit card approvals, and more. Improve your score, pay bills on time, keep credit utilization low, and avoid opening too many credit accounts. Monitor your credit regularly, use free services like Credit Karma to keep an eye on your score and make sure it stays in good shape. Step 8, plan for retirement early. Goal, start preparing for a secure retirement by understanding retirement accounts and strategies. What to do? Start contributing to a retirement account, whether it's a 401(k), IRA, or Roth IRA, begin making contributions as early as possible. Understand the power of compound interest, the earlier you start, the more your money will grow over time due to compound interest. Consider investment options for retirement, diversify your retirement savings by investing in stocks, bonds, and mutual funds. Step 9, continuously educate yourself and stay updated. Goal, keep learning and improving your financial knowledge. What to do? Subscribe to finance news, follow blogs, podcasts, and YouTube channels to stay updated on financial trends and strategies. Engage in regular self-education, read finance books, attend seminars, and take courses to enhance your knowledge further. Evaluate your financial plan, regularly assess your goals and adjust your financial plan to stay on track. Step 10, take action and build confidence. Goal, put everything you've learned into action and develop financial confidence. What to do? Set clear financial goals, whether it's saving for a house, paying off debt, or building wealth. Create specific financial goals. Track your progress, regularly monitor your finances to ensure you're meeting your goals. Stay committed. Financial literacy is an ongoing journey, so continue to educate yourself, adjust strategies, and stay focused on your goals. Conclusion. Mastering the basics of finance is a step-by-step process that requires dedication, practice, and patience. By following these 10 steps, you'll gradually develop essential money skills that will serve you well, whether for personal finance management or professional success. Start small, stay consistent, and watch your financial literacy grow over time. Summary: learn and master the basics of finance. To master essential money skills, follow this step-by-step process. Understand key concepts, learn basic financial terms and how to read financial statements. Budgeting, track spending, create a budget, example 50/30/20 rule, and use budgeting apps. Credit and debt management. Learn about credit scores, types of debt, and debt repayment strategies. Save and build an emergency fund. Open a savings account, aim for 3 to 6 months of expenses in an emergency fund, and automate savings. Investing basics. Learn about stocks, bonds, mutual funds, and tax-advantaged accounts like IRAs. Understand taxes. Learn tax basics, maximize deductions, and utilize retirement accounts to save on taxes. Credit score management. Keep your credit score in good shape by paying bills on time and maintaining low credit usage. Retirement planning. Contribute early to retirement accounts, leverage compound interest, and diversify your portfolio. Continual learning. Keep educating yourself by subscribing to finance resources and engaging in self-education. Take action, set financial goals, track progress, and stay committed to improving your financial literacy. By following these steps, you can confidently manage your finances and grow your wealth over time. Thank you. Disclaimer: the content provided in this video is for informational purposes only and should not be considered as financial advice. Always seek the guidance of a qualified financial professional for personalized advice regarding your financial situation.